Welcome to the deep dive. If the words real estate math conjure up feelings of dread, maybe bringing back some less than fond memories of dusty textbooks and complicated formulas, you are absolutely not alone.
Mm-hmm.
It's one of those topics that can feel like a big gatekeeper standing between you and that real estate license.
It really can.
But what if we told you that mastering this math isn't just about passing an exam? What if it's actually about building a practical financial superpower that will fundamentally change how you operate as an agent?
That's exactly the right way to think about it. Yeah.
Yeah.
This is an abstract theory. It's about giving you the essential tools to understand the core financial mechanics of real estate transactions.
Okay.
From calculating your own potential income to helping your clients navigate complex closing costs and even, analyzing potential investment opportunities. This math is absolutely critical.
Right.
Being comfortable with these numbers, it builds your confidence, it enhances your credibility, and it's fundamental to building trust with everyone you work with.
And that's precisely the mission for this deep dive.
Yeah.
We've got a stack of source material here. Guides, articles, lots of practice problems shared by a listener who's ready to unlock that financial superpower, specifically tailored for the California real estate landscape.
Right.
We're going to pull out the most important nuggets from this material.
We're diving into the fundamental calculations you'll encounter. That means understanding how commissions are determined, tackling the often confusing world of prorations at closing.
Oh, always confusing, yeah.
Getting a handle on basic loan math, and touching on some key metrics used in analyzing investment properties. The goal is to take these areas, which might seem daunting right now, and turn them into clear, understandable pathways.
Okay.
By the end of this deep dive, you should feel much more equipped to handle the numbers you'll face in the real world, and, yes, on the exam, becoming a more informed and capable agent.
Okay, let's unpack this. Where do we even begin to build this superpower?
The sources really emphasize starting with the absolute foundation, which boils down to understanding percentages and something they call the T-bar method.
Right. Percentages are absolutely everywhere in real estate. You've got commission rates, interest rates, tax rates, even loan-to-value ratios. They pop up constantly.
Constantly.
And many of the calculations involving these percentages relate back to the relationship between a part, a whole, and a rate. The T-bar is simply a very, very useful visual tool to keep those relationships straight.
So you picture a large T, right? Or think of it like a triangle divided horizontally. The part is always on top.
Always on top.
And the whole and the rate are on the bottom side by side. The horizontal line represents division, and that vertical line between the whole and rate represents multiplication.
Exactly. The part is always just a piece or a portion of the whole. So think of it like this. A commission amount is a part of the total sale price.
A piece of the pie. Exactly. The whole is the complete item or value, the entire sale price of the property. The full loan amount may be the total market value. And the rate is always expressed as a percentage.
And once you have that visual, the formulas almost derive themselves, it seems. If you're trying to find the part, you cover it up on the T, and you see whole next to rate, separated by that vertical line, meaning you multiply them. So part equals whole ec rate. Simple enough.
Correct. Straightforward. Now, if you know the part and the rate and you want to find the whole, you cover up the whole on the T. You see part over rate separated by the horizontal line.
Division.
That means you divide. Whole, part A, rate. And this is a crucial point the sources emphasize. Whenever you are dividing to find either the whole or the rate, the part number must go into your calculator first.
Okay. That's key.
It's part divided by something else. Always part first.
That's a common calculator mistake. Good reminder. So if you're trying to find the rate, the percentage, you cover that up and you see part over whole. Again, division, rate, part A whole.
Yeah.
And following that crucial rule, part goes into the calculator first.
Precisely. And when you're calculating the rate, after you divide the part by the whole, you'll get a decimal. The sources recommend using the percentage key on your calculator if it has one.
Handy if it does.
Or simply multiplying the decimal by 100, to convert it back into a percentage.
Right, standard conversion. So this part-whole rate concept, visualized with the T-bar, is incredibly versatile then. The sources say it's applicable to a wide range of real estate math problems.
It's really the cornerstone for calculations involving percentages and monetary values that are fractions of a larger sum. It comes up again and again.
Okay.
Now, the sources do note that this framework doesn't apply to calculations involving area or volume, like square footage or cubic yards.
Different math entirely.
Exactly. Those require different geometric formulas. But for a huge chunk of the financial math you'll encounter, this is your go-to tool.
And I can see how having this framework makes you faster and, frankly, more confident. Instead of trying to remember 3 separate formulas in the heat of the moment,
Right.
you just remember the relationship between part, whole, and rate and how they fit into the T-bar. It's like having a little cheat sheet built into your understanding.
Exactly. And that understanding isn't just for the exam, as we said. Being able to quickly grasp and calculate these relationships helps you immensely in conversations with clients.
How so?
Well, you can explain how a commission is calculated or how a down payment affects the loan amount and LTV using this simple framework. It clarifies things for them, makes it less intimidating,
Yeah.
and it shows you're competent with the numbers, which is a big part of building that all-important trust. That's our adapt and connect piece here, adapting the math to client conversations builds connection.
Okay, good point. All right, speaking of building trust and understanding client costs, and importantly, how you get paid, let's move on to a fundamental application of that part-whole rate concept, calculating commissions.
Commission calculation is probably the most direct use of the part-whole rate formula for a new agent. The commission amount is your part, the whole is almost always the property's sale price, and the rate is the agreed-upon commission percentage.
And crucially, as the sources highlight, commission is based on the sale price, not the list price.
Very important distinction.
Unless, by some chance, they happen to be the same amount.
Right. Sale price is the key figure.
Okay, let's put this into action. Let's think like an agent here, with a scenario straight from the source material. Imagine you successfully represent the seller for a property that closes at a sale price of $750,000. The total commission rate agreed upon in the listing agreement is 5%. How much is the total commission amount?
Okay, using our formula, part equals whole air rate. The part we're looking for, commission amount. Whole, $750,000 sale price, ask rate, 5% commission rate.
So $750,000 times 5%. And remember to use the decimal 0.05 or the percent key on your calculator. $750,000 multiplied by 5% equals $37,500.
There you go. That's the total commission paid on that transaction.
Okay.
Now let's flip it. Let's consider a different angle. Suppose you were the buyer's agent and you know the total commission paid was $30,000 on a property that sold for $600,000. What was the commission rate for that transaction?
Okay, now we know the part $30,000 commission amount and the whole $600,000 sale price. We're looking for the rate. The formula is rate part yield
whole. And here's where that crucial rule comes back. Part goes first in the calculator.
Always part first.
So $30,000 divided by $600,000.
$30,000 divided by $600,000.
Right.
That gives us 0.05.
Right.
Multiply by 100 or use the percent key and you get 5%. So the commission rate was 5%. This confirms the part-whole rate works beautifully in both directions, finding the part and finding the rate.
Exactly. Now, the sources go a bit deeper than just simple commissions. They discuss more complex commission structures. One notable example they detail is tiered commissions.
Tiered, like steps.
Yes, sometimes referred to as marginal or tax rate commission because it functions similarly to income tax brackets. The commission rate actually changes based on the volume of sales achieved.
Okay, this sounds like it could get complicated quickly if you don't break it down properly.
It can, absolutely. But applying the part-whole rate concept to each tier makes it manageable. Let's look at the specific example in the source. It describes an agent who earned a total commission of $85,000.
Okay, $85K total earnings.
Their agreement states they earn 4.5% on the first $500,000 of their sales volume for the year.
First $500,000 at 4.5%.
And then a higher rate, 6%, on all sales volume over that $500,000 threshold.
Okay, so a jump in rate after 500K.
Right. The question is, what was the total sales volume this agent achieved to earn that $85,000?
Okay, so the total commission is $85,000, and we have two different rates applying to different chunks of sales volume. We can't just use a single part whole rate calculation for the total amount. It's split.
Exactly. You have to work through it step by step, tier by tier. First, calculate the commission earned on the first tier of sales. We know the whole for that tier, $500,000 sales volume, and the rate, 4.5%.
Right. So commission from tier 1, whole H rate, equals $500,000 times 4.5%. Let's see. 500,000 times 0.045 is $22,500.
Correct. $22,500. That's how much commission was earned just on that first $500,000 in sales.
Got it.
Now we know the total commission earned was $85,000, and we just found that $22,500 of that came from the first tier. So the remainder must have come from the second higher tier, the 6% tier.
Okay, simple subtraction.
We subtract the tier 1 commission from the total commission. $85,000 total commission, $22,500 commission from Tier 1, that's $62,500.
Okay, $62,500.
This $62,500 is the part, it's the amount of commission earned specifically from the sales volume above the initial $500,000.
Okay, so the second tier calculation, we have the part at $62,500 commission, and we know the rate for that tier, 6%. We need to find the sales volume for that tier, which is the whole. The formula is whole, part E rate.
And following the rule.
Part goes first in the calculator, always. Sales volume for tier 2, $62,500, 0.6%. So $62,500 divided by 0.06.
Let's run that.
$62,500, 0.6 equals $1,041,666.67. Is that right?
That's it. $1,041,666.67. But remember, that's the sales volume only for the transactions that fell into the 6% tier, the sales volume over the initial $500,000 mark.
Ah, right. Not the total volume yet.
Correct. The final step to find the total sales volume is to add the sales volume from the first tier and the sales volume from the second tier together.
Okay, so total sales volume equals $500,000. Sales from Tier 1 plus $1,041,666.67 sales from Tier 2.
Add them up.
That sums up to $1,541,666.67.
And that matches the answer provided in the source example.
Perfect.
This really demonstrates how breaking down a complex problem into smaller, manageable steps, applying the basic part-whole rate concept to each part, allows you to solve it systematically.
It really does.
It's a critical skill for understanding how your income is calculated, especially if you're a high-producing agent or perhaps working under certain brokerage models with tiered structures.
Yeah, makes sense.
The sources do briefly mention other commission structures exist, like flat fees or maybe referral fees. But the core math focus, the stuff you really need to practice, is clearly on these percentage-based calculations tied to sale price and volume.
And thinking about the ethical compass here, being able to calculate these accurately isn't just about making sure you get paid correctly, though that's important too.
Of course.
It's fundamentally about being completely transparent with your clients about commission costs, which are a significant part of any transaction. Getting this number wrong, even accidentally, can cause major problems and really erode that trust we talked about. Accuracy here is paramount for ethical practice.
Absolutely. You have to be precise. Now, moving beyond commission, let's talk about another area where math is absolutely essential at the closing table. Prorations.
The prorations, right. Splitting things up fairly, is that the basic idea?
Precisely. Proration is the process of dividing certain expenses and sometimes income between the buyer and seller in a real estate transaction. It's based on the number of days each party owns the property during the period those expenses or income cover. It's about making sure each party pays for or benefits from only the days they actually owned or will own the property within a specific payment cycle.
Why is this necessary, though? Can't they just sort of pay for what they used up to the closing day?
The complication arises because some expenses, like property taxes or mortgage interest, are often paid in arrears.
Arrears, meaning paid after the fact.
Exactly. That means you pay for the period after you've already incurred the cost or used the service. Other things, like rent on an income property or sometimes homeowners association dues or maybe insurance premiums, are paid in advance.
Ah, okay. So payments don't always line up neatly with the closing date.
Rarely do they. Since closing rarely happens neatly at the very beginning or very end of a payment cycle, you have to adjust for the period where one party paid but the other benefited, or maybe one party benefited but the other party will actually be paying the bill later on.
Okay, so if property taxes are paid in arrears, like you said, the seller has been living in the house for, say, half the tax year, but the tax bill for that period won't come until later.
Right, maybe months later.
And the buyer, the new owner, will be the one getting and paying the entire tax bill when it arrives.
Exactly. That wouldn't be fair to the buyer, right?
Yeah.
So the seller owes the buyer a credit at closing for the portion of the taxes covering the seller's period of ownership, up to and including the closing day.
Okay, so the buyer gets this credit because they will later have to pay the full tax bill that includes the seller's share.
You got it. It evens things out. Common items prorated include, as we said, property taxes, interest on any assumed loans, though assumptions are less common these days, rent on investment properties, homeowner association dues, and sometimes things like utilities or mortgage insurance impounds held in escrow.
The sources discuss calculating prorations using two different methods. The 360-day year and the 365-day year. What's the difference there?
Yes. The 360-day year, often called the banker's year or statutory year, is a simplified method. It assumes every single month has exactly 30 days.
Regardless of reality, February has 30 days.
Yep. Makes the math a bit easier sometimes because 12 times 30 is a nice round 360 days. The 365-day year or calendar year method uses the actual number of days in the calendar year, accounting for the fact that months have 28, 30, or 31 days.
Okay.
The sources note you generally don't need to worry about leap years for exam purposes. Even when you're using the 365-day method, just use 365.
Okay. Good to know. Now here's our CA Corner moment. The sources specifically point out that in California real estate transactions, the 365-day method is typically used for prorations.
That's correct. Industry standard in California.
So while it's good to understand the 360-day method exists, perhaps for context or maybe some lender calculations, aspiring California agents should really focus their practice primarily on the 365-day calculation, counting the actual days in the relevant months.
Absolutely. Focus on the 365-day method for California practice. The general formula for proration, though, regardless of which year you're using, is to first find the daily rate for the expense or income item.
Daily rate. Okay.
You take the total amount for the period, like annual taxes, and divide it by the total number of days in that period, either 360 or 365, or sometimes the actual days in a specific month for things like rent. That gives you the cost per day.
So daily rate, total amount, total days in period.
Correct.
Yeah.
Then you multiply that daily rate by the number of days applicable to the party who owes the money or is due the credit.
Proration amount equals daily rate, applicable days.
Exactly.
So if annual property taxes are, say, $4,015, and we're using the 365-day year, the daily tax rate is $4,015 divided by 365, which is $11 per day.
Exactly. And then you'd figure out how many days the seller owned it within that tax period or how many days the buyer will own it, depending on what you're calculating. These proration amounts appear on the settlement statement, which you'll know as the closing disclosure.
Right, the CD.
As debits and credits. A debit is an amount someone owes or is paying at closing. A credit is an amount someone receives or is relieved from having to pay later.
Debit is a charge. Credit is a credit.
Simple way to think of it.
Let's walk through the examples from the source material to see how this works in practice and really nail down how the debits and credits appear. Let's take property taxes paid in arrears first. Suppose annual taxes are $1,825 and closing is on May 10th. We're using the 365-day year as is standard in California.
Okay.
The seller owes taxes for the period they own the property from January 1st up to and including the closing day, May 10th.
Okay, first step is to count the seller's days of ownership in that period. Let's see. January has 31 days. February normally 28. We ignore leap year per the source. March 31, April 30, plus the 10 days in May up to and including the 10th.
Okay, 31 plus 28 plus 31 plus 30 plus 10, that equals 130 days.
Correct. The seller owned the property for 130 days of the tax year before closing.
Now, the daily tax rate, the annual tax is $1,825. Using the 365-day year, 1,825 dev, 365 days equal $5 per day. Nice round number.
Perfect. So the seller owes for 130 days. $5 per day multiplied by 130 days equals $650.
$650.
This $650 represents the seller's share of the eventual tax bill. Now, how does it appear on the settlement statement?
Well, since the buyer will later pay the full bill that includes this $650 amount, the seller needs to give that money to the buyer, essentially. So the seller is divided $650 at closing. That means $650 comes out of the seller's proceeds.
Right.
And the buyer's credited $650, meaning $650 is added to the buyer's side of the ledger to offset the future tax payment they will make. That includes the seller's portion.
Perfect. Debit seller, credit buyer for taxes, paid in arrears, covering the seller's ownership period. That makes sense. The seller is reimbursing the buyer for the seller's share of a bill the buyer will eventually cover.
Okay, got it. What about the opposite scenario? Rent paid in advance on an income property.
Good one. Let's say monthly rent is $1,200 paid by the tenant on the 1st of the month. Closing happens on the 20th of a 30-day month.
Okay, seller collected the full $1,200 on the 1st.
Right. The seller received the full $1,200 rent for the entire month on the 1st. But the buyer will own the property starting the day after closing, so from the 21st through the end of the month, which is the 30th in this case. The seller has rent money for days they won't own the property.
So the seller owes the buyer the rent for those days, the buyer will own it.
Exactly.
Okay, how many days does the buyer own it in that month? From the 21st to the 30th inclusive? 21, 22, 23?
Yeah.
Up to 30, that's 10 days.
Correct, 10 days. Now, the daily rent. For monthly items like this, you usually divide by the actual number of days in that specific month. So, $1,200 divided by 30 days in this month equals $40 per day.
$40 a day.
The seller owes the buyer for those 10 days. $40 per day times 10 days equals $400.
Okay.
$400. This $400 needs to come out of the seller's proceeds and be given to the buyer, since the buyer won't be collecting rent for those 10 days but owns the property. So the seller is debited $400.
Debit seller again.
And the buyer is credited $400.
Credit buyer again. So debit seller, credit buyer again, but this time it's dividing income that was received in advance by the seller.
Okay. Now the buyer's new loan interest at closing, that feels a bit different, as the source example shows.
It is handled differently, yes.
Yeah.
When a buyer gets a new mortgage, their first full monthly payment is typically due not on the first of the next month, but the first of the month after that.
So if you close in May, the first payment isn't June 1st, it's July 1st. Often, yes, and that July 1st payment covers the interest for the month of June, paid in arrears. However, interest on the new loan starts accruing from the day the loan funds, which is usually the closing day.
Oh, okay.
The buyer is responsible for paying the interest that accrues from the closing date up to the end of the calendar month in which closing occurs. And this interest is typically paid at closing. It's prepaid interest.
Okay, so if closing is on October 15th and the new loan funds that day, the buyer owes interest for October 15th through October 31st.
Exactly.
Counting the closing day, October 15th, 15th, 16th, 31, that's 17 days.
Precisely. This is often called per diem interest or interim interest. Let's use the source example.
Okay.
A buyer closes on May 18th. It's a 31-day month. They have a new loan of $250,000 at 6% annual interest. Now, interestingly, the source uses the 360-day year method in this specific example for the interest calculation, even though California usually uses 365 for prorations. Lenders sometimes use 360 for daily interest.
Okay, so we follow the example. Annual interest is $250,000, 6% dollars per year.
Right. Now, the daily interest, using the 360-day method, $15,000 divided by 360 days equals $41.6667 per day.
Okay, $41.67 roughly per day.
Now, how many days does the buyer owe interest for in May? From closing May 18th to the end of May, May 31st, inclusive. Let's count. 18, 19, 20, 21, 22, 23, 24, 25, 26, 26, 27, 29, 30, 31. That's 14 days.
14 days.
So the interest owed at closing is $41.6667 per day times 14 days equals $583.33.
$583.33. And who gets debited or credited here?
Well, the buyer owes this amount at closing to cover the interest from closing day to the end of the month. Since the buyer is paying this amount at closing, it's a debit to the buyer.
Debit buyer. Okay, this is the first example where the buyer is debited in these proration-like calculations. It makes sense because they are essentially prepaying for the interest they will incur from closing through the end of the month.
Exactly. It prevents them from being immediately delinquent on interest that's already accrued before their first full payment is even due.
Another common proration must be HOA dues, right? They're often paid quarterly or annually in advance.
That's another great example, yes. If closing happens partway through a quarter that the seller already paid for, the seller would get a credit back for the days the buyer will own the property during that prepaid period.
And the buyer would get a debit for that same amount because they were effectively buying that prepaid portion from the seller.
Precisely. Debit buyer, credit seller in that case. The sources also briefly mention a related concept for tax purposes, specifically for rental properties.
Oh, yeah.
The proration of expenses like taxes and mortgage interest for calculating deductions is based on the number of days the property was rented versus used personally. It's a slightly different application than the proration at closing for ownership transfer between buyer and seller, but the core principle is similar, fairly dividing costs based on a specific period of use or ownership.
Okay. So back to the closing itself. Getting these prorations right seems absolutely essential for a smooth closing. It's part of that ethical compass again, isn't it?
Definitely. It ensures that the financial settlement between the buyer and seller is fair and accurate down to the day. Mistakes here can lead to significant disputes and major headaches post-closing.
Yeah, nobody wants that.
It's a core part of your responsibility as an agent to understand these figures on the settlement statement and be able to explain them, at least generally, to your client.
Okay. Prorations handled.
Yeah.
Let's transition now to the math involved in financing something every agent needs to grasp, even if they aren't a lender, to help their buyers understand the true cost of home ownership.
Absolutely critical. Buyers often look to their agent for guidance, not just on finding the right house, but understanding the numbers related to the loan, the closing costs, the monthly payments.
The whole financial picture.
Exactly. And at a fundamental level, understanding interest is key. The sources make a point to distinguish between simple and compound interest.
Simple interest sounds simple.
It is, relatively speaking. Simple interest is calculated only on the original principal amount borrowed. So if you borrowed $1,000 at 10% simple interest per year, you just pay $100 in interest each year, 1,010%, regardless of how long you took to pay it back, assuming you kept paying the interest. The principal would still be due eventually, of course.
Okay, but mortgages don't work like that, right?
Generally, no. Mortgages involve compound interest, although the monthly calculations often look like simple interest on the current balance. Compound interest is where things get interesting, or maybe scary, like you said, depending on if you're borrowing or saving.
Great.
Compound interest is calculated on the principal plus any accumulated interest from previous periods. Interest starts earning interest.
That's the snowball effect.
Precisely. For a long-term mortgage, this compounding effect, applied frequently, means the total amount of interest paid over the life of the loan is vastly higher than if it were simple interest on the original amount. Because the balance on which interest is calculated only decreases slowly, especially in the early years.
But on the flip side,
For savings or investments, compound interest is your best friend. It allows your money to grow exponentially over time. Time is a huge factor.
the sources also mention the rule of 72 as a quick mental math trick related to compound interest. How did that work?
Yeah, it's a handy rule of thumb. It's a way to estimate how many years it takes for an investment to double in value at a fixed annual compound interest rate. You just divide the number 72 by the annual interest rate percentage.
So if you had an investment, say, in a mutual fund, and you hoped it would grow at an average annual rate of 6%,
Okay.
it would take approximately 72 divided by 6. It would take approximately 72 divided by 6. 12 years to double your money, roughly.
Exactly. Or if interest rates were higher, say 8%, it would take about 72 divided by 8. Only 9 years to double. It's just an estimate, but it's a very quick way to illustrate the power of compounding over time to clients, whether talking savings or even the cost of debt.
Interesting. Okay, now let's get into the mortgage payments themselves. We know a fixed monthly payment on a typical amortizing loan covers both interest and principal, or P&I. How do you figure out how much of that payment is which part?
Okay, the first step for calculating any specific payments breakdown is to determine the amount of interest due for that payment period. For a standard monthly payment, you take the current outstanding loan balance.
The balance before making this payment.
Yes, the current principal balance. You multiply that by the annual interest rate and then divide by 12 months to get the interest for that 1 month.
Okay, so monthly interest, current loan balance X, annual interest rate 12.
That's the formula. The sources also show that sometimes interest is calculated on a daily basis for specific periods, like that prepaid interest at closing we discussed. Using the daily rate, annual interest 360 or 365 days, multiplied by the exact number of days in the period. But for a regular monthly payment, dividing the annual rate by 12 is standard.
Okay, so once you know the interest portion for that specific monthly payment, the rest of that fixed payment must be going toward reducing the principal loan balance, right?
Exactly. The principal portion of the payment, total fixed monthly, P&I, payment monthly interest portion you just calculated.
Yeah.
And then the new loan balance after making that payment is simply the old loan balance minus the principal portion you just paid.
Old loan balance, principal portion paid. New loan balance.
That's how the balance steps down each month.
And because the loan balance decreases slightly with each payment, the amount of interest due for the next payment will be slightly lower.
Calculated on a smaller balance.
Which means a slightly larger portion of that next fixed payment goes towards principal.
Correct.
This slow shift from paying mostly interest in the early years of the loan to paying mostly principal in the later years, that's called amortization, right?
That is exactly what amortization is. Let's take one of the detailed examples from the source to illustrate this process over, say, the first few months. It really makes it clear. Suppose we have a loan with an initial balance of $200,000.
Okay, 200 RK loan.
The annual interest rate is 7%, and the fixed monthly principal and interest payment is $3,330.60. Let's calculate the loan balance after the first 3 months' payments using the monthly interest calculation method shown in the source.
All right, month 1. Starting balance is $200,000. Annual rate is 7%, so the monthly interest rate is 7% divided by 12. That's 0.005833.
Right. Keep a few decimal places for accuracy. So interest for month one is $200,000, current balance, 0.0712. That comes out to $11,166.67.
Okay, $1,166.67 just in interest for the first month. Now, the principal portion for month one is the total payment, $1,330.60 minus that interest, well, $1,166.67, which equals $163.93.
Only $163.93 going to principal in the first payment.
Wow, okay, so the new loan balance after month one is $200,000, whole balance, $160.93 principal paid, $199,836.07.
Correct.
Wow, only $163.93 of that first $1,330 payment went towards actually reducing the principal. That really hammers home how interest-heavy the early payments are on a long-term loan.
It does, and it's really important for buyers to understand this dynamic.
Yep.
Now, let's do month two. The starting balance is the new balance we just calculated, $199,836.07.
Okay, interest for month two, $199,836.72 slightly less interest this month because the balance is slightly lower.
Exactly, just a tiny bit lower. So the principal portion for month two is $1,330.60 total payment, $11,165.72 interest, $164.88.
Okay, so the principal portion increased slightly by almost $1.
See? Starting to shift, albeit slowly. The new loan balance after month two is $199,836.70.
$199,671.19.
And let's do one more. Month three, starting balance, $199,671.19. Interest for month three, $199,671.19. Almost 7.18 cents. Interest dropped again, just slightly.
Right. Principal portion for month three, $1,330.60, $164.76 equals $165.84. Principal portion nudged up again.
Okay. New loan balance after month three. $199,670.19, $165.84 equals $199,505.35. There we go. So over just 3 months, you can clearly see the balance slowly reducing and that split between interest and principal gradually shifting.
Yeah, the interest portion decreases and the principal portion increases with each payment.
Understanding this helps you explain to clients why making extra principal payments can significantly accelerate the loan payoff and save a lot of interest over time, or conversely, why their loan balance seems to go down so agonizingly slowly in the first few years if they just make the minimum payments.
That's a really practical insight. Now, beyond the monthly payment split, agents also need to understand other key loan concepts involving math, like loan-to-value ratio or LTV, and maybe points.
Absolutely. The loan-to-value or LTV ratio is a fundamental concept. It's a measure used by lenders primarily to assess their risk on a loan.
How's it calculated?
It's simply the ratio of the loan amount compared to the property's value. Usually the value used is the lesser of the purchase price or the appraised value, so LTV, loan amount property value.
Okay, so this ratio basically tells the lender how much skin the borrower has in the game, how much equity they have from the start. If the LTV is 80%,
that means the loan covers 80% of the value, and the buyer needs to put down the other 20% as a down payment.
right, and if the LTV is higher, say 90% or 95%.
The buyer needs a smaller down payment, 10% or 5%, but the lender perceives the loan as being riskier.
And that higher risk often leads to.
Exactly. This sources emphasize that an LTV above 80% often triggers the requirement for private mortgage insurance, or PMI.
Ah, PMI, that's that extra monthly cost for the buyer, right? On top of PATI.
It is. PMI protects the lender, importantly not the borrower, in case the borrower defaults on the loan, especially when the borrower has less equity built up initially.
So it's insurance for the lender that the borrower pays for.
Pretty much, yeah. The cost is typically calculated as an annual premium, maybe around 0.5% to 1% of the loan amount, but it's usually paid in monthly installments as part of the total house payment.
Okay, so let's run a quick number. For a $400,000 loan with a 90% LTV, meaning a 10% down payment, if PMI is required at, say, 0.75% annually.
The annual PMI cost would be $400,000.0075 equals $3,000 per year.
$3,000 a year. Divided monthly, that's $250 added to their housing payment each month. Ouch.
It adds up. Buyers usually have to pay PMI until their loan balance drops to 80% of the original property value, or sometimes lower depending on the loan terms and regulations. Understanding LTV and PMI is crucial for accurately estimating a buyer's total monthly housing cost, which, as you said, often includes principal, interest, taxes and insurance, PITI, and sometimes PMI and HOA dues too.
That full picture is so important for affordability. Okay, what about discount points?
Discount points are different. These are fees paid up front, right at closing, directly to the lender.
Why would someone pay extra fees up front?
In exchange for those points, the lender gives the borrower a slightly reduced interest rate over the entire life of the loan. One discount point typically costs 1% of the total loan amount.
Okay, so paying 2 points on a $500,000 loan would cost an extra $10,000 at closing. 2 points, 1%, $500,000.
Exactly. $10,000 up front. Now, is that worth it? That's the question.
Right. How do you figure that out?
The sources mention calculating the break-even time frame. This helps buyers decide if paying points makes financial sense for their situation.
Break-even time frame. How's that calculated?
It's the total cost of the discount points divided by the amount saved on the monthly P&I payment due to the lower interest rate obtained by paying those points. So break-even time, cost of points, monthly payment savings.
Okay, let's use our example. Paying 2 points costs $10,000. Let's say that lower rate saves the buyer $60 per month on their principal and interest payment compared to the rate without points.
So the break-even time is $10,000 divided by $60 per month savings.
10,000 divided by 60 equals 166.67 months.
Right. And 166.67 months is, what, about 13.9 years?
Almost 14 years.
This calculation helps the buyer see that if they plan to keep that specific loan for longer than about 14 years, paying the points up front could potentially save them money in the long run, because after the break-even point, the monthly savings continue.
But if they plan to sell the house or refinance the loan sooner than 14 years,
then paying those points might not be worth the upfront cost, because they wouldn't recoup the initial $10,000 through the monthly savings before getting rid of the loan.
that's a really valuable calculation for advising clients. Being able to walk a buyer through these kinds of calculations, showing them the LTV impact, estimating potential PMI costs, and calculating the break-even for points, it demonstrates a much deeper understanding of the financing process. It's part of that adapt and connect theme again.
Definitely.
It helps set realistic expectations about total costs and empowers the buyer to make informed decisions based on their own plans and financial situation. That builds immense trust.
And, it connects directly to understanding how broader financial factors, like a client's credit score, which was mentioned in one of the source materials regarding personal loans. But the principle applies here to broadly impact the interest rate a borrower qualifies for in the first place.
Right. A better credit score usually means a lower interest rate.
Which in turn affects all these calculations, the monthly payment, the amortization speed, the potential benefit of paying points. It's all interconnected.
Absolutely. Okay, so we've covered math relevant to homeowners. Now, beyond helping homeowners, many agents also work with investors. The sources touch on some key math concepts important in analyzing investment properties.
That's right. The math shifts focus a bit here towards evaluating profitability and return on investment.
It sounds like it moves beyond just basic percentages and loan payments. More specialized.
It does, yes. But the underlying goal is still using math to understand financial performance and make informed decisions. One of the most common metrics you'll hear about is the capitalization rate, or cap rate.
Cap rate. Heard that term a lot. What is it exactly?
It's a relatively simple calculation used primarily to estimate an investor's potential unlevered return over 1 year. Unlevered means it assumes a property is bought with all cash, no mortgage involved.
Okay, return assuming no loan.
Right. And maybe more importantly, it's used to quickly compare the potential profitability of similar investment properties.
How is cap rate calculated?
Cap rate is calculated as the property's net operating income, NOI, divided by its current market value, or often the purchase price. So cap rate NOI value, or price.
Okay, makes sense. But what is net operating income, NOI? How do you get that number?
Good question. NOI is the property's annual income from its operations, primarily rent collected minus its annual operating expenses.
Operating expenses.
Yeah. These include things like property taxes, property insurance, property management fees, if any, routine maintenance and repairs, landscaping, utilities paid by the owner, like water or trash sometimes.
Okay.
Crucially, NOI does not include the owner's mortgage payments, principal and interest, income taxes, depreciation, which is a non-cash accounting expense, or capital expenditures like major renovations, a new roof, etc. It's just the income minus the day-to-day operating costs.
Got it. So let's say a small rental property generates $30,000 in annual rent, and it has $10,000 in annual operating expenses, taxes, insurance, basic upkeep. The NOI would be $30,000. $10,000, $20,000.
Correct. $20,000 NOI. Now, if that property is valued at or you're buying it for $400,000.
The cap rate would be $20,000 NOI divided by $400,000 value.
Right.
$20,000, $400,000 equals 0.05.
Or 5%. That 5% cap rate gives an investor a quick snapshot of the potential return if they paid all cash, and it allows them to compare it to, say, another property down the street that might have a 6% cap rate or one in a different area with a 4% cap rate. Generally, a higher cap rate suggests a potentially higher return relative to the price, but often implies higher risk too.
Okay, quick comparison tool. But the sources correctly point out that cap rate has significant limitations, right?
Absolutely. It's a simple tool, which is both its strength and weakness. As we noted, it doesn't consider how financing, using a loan or leverage, impacts the actual cash return the investor gets on their own money put into the deal.
Right, most investors use loans.
Exactly. It also doesn't account for the time value of money. A dollar today is worth more than a dollar next year, and it's just a snapshot based on current income and value. It doesn't predict future changes in rent, expenses, property value, or the impact of any planned improvements.
So it's a starting point, not the whole story.
Precisely. Which is why more sophisticated investors often use methods like discounted cash flow or DCF analysis, which is also briefly mentioned in the source material.
DCF, that sounds more intense.
It is. DCF is a much more complex valuation method where an investor projects all the expected future cash flows from a property income minus all expenses, sometimes including the expected sale proceeds at the end of their holding period over a period of years.
Okay, forecasting everything.
Yes. And then they discount those future cash flows back to their present value using a required rate of return, which reflects the investor's risk tolerance and opportunity cost.
Wow, okay. That definitely sounds like a deep dive within this deep dive, and probably involves spreadsheets and financial modeling software rather than just a basic handheld calculator.
Exactly. It's much more involved. It attempts to account for the time value of money and future expectations, unlike the simple cap rate. The sources touch on it and its relationship to things like the internal rate of return, IRR, but they present it more as a concept sophisticated investors use rather than something an agent needs to calculate daily. Still, understanding the concept is valuable when working with investors.
Good to know it exists and what it generally tries to do. What other metrics for investors were mentioned? Cash-on-cash return.
Yes, cash-on-cash return is another important one, especially for investors using leverage. It looks at the annual pre-tax cash flow generated by the property that's NOI minus mortgage payments, debt service.
So the actual cash left in the pocket before taxes.
Right. It compares that annual cash flow to the actual amount of cash the investor put into the deal, typically the down payment plus closing costs. Cash-on-cash return equals annual pre-tax cash flow total cash invested.
Okay, so that shows the return specifically on the cash they personally invested. Seems very practical.
It is. It's a very common metric investors use to evaluate how hard their invested capital is working in a particular deal, especially when comparing different deals with different financing structures.
Makes sense. And debt service coverage ratio, DSCR.
That's a ratio lenders, particularly commercial lenders, look at very closely when evaluating a loan application for an income property. It compares the property's net operating income, NOI, to the total annual mortgage payments, principal and interest, which is called the annual debt service.
So DSCR, NOI, annual debt service. What does it tell the lender?
It shows whether the property's operating income is sufficient to cover the mortgage payments. Lenders want to see a cushion. A DSCR of 1.0 means the NOI exactly covers the debt service. Lenders typically require a ratio of 1.10, 1.25, or even higher.
Meaning the NOI needs to be at least 20-25% greater than the mortgage payment.
Exactly. It provides a safety margin in case income drops or expenses rise unexpectedly.
Okay, lender's perspective there. And finally, there was that simple rule of thumb the sources mentioned for fix and flip investors. Maximum investment equals ARV down 0.70. What's ARV?
ARV stands for after repair value. It's what the flipper estimates the property will be worth after they complete all the renovations.
Okay.
The 70% rule is a common guideline, not a hard rule, that flippers use to quickly estimate their maximum allowable offer price plus planned repair costs. If they expect a property to be worth $500,000 after repairs, the ARV,
They might aim to acquire it and fix it up for no more than 70% of that, which is $500,000.77, equal of $350,000.
right, that $350,000 is their target for the purchase price plus the estimated renovation costs combined. The remaining 30%, or $150,000 in this case, is intended to cover their financing costs, holding costs, taxes, insurance while they own it, selling costs, commissions, closing costs, and importantly, their desired profit margin.
So it's a quick filter to see if a potential deal might have enough room for profit.
Exactly, a starting point for analysis. Understanding these investment math concepts, even just knowing what cap rate, NOI, cash on cash, DSCR, and the 70% rule are, and how investors use them, allows you, as an agent, to better speak the language of your investor clients.
Right, build rapport and credibility.
You can have more informed conversations about their specific goals, help them analyze potential deals from their perspective, and position yourself as a valuable resource who understands the financial side of real estate investing. This really helps you adapt and connect your services based on very different client objectives, home ownership versus investment return.
Absolutely. Now, we've covered a lot of ground here, from basic percentages all the way to investment metrics. The single most important piece of advice echoed throughout all the source material for mastering all of this math seems to be practice.
Consistent practice. There's just no substitute.
It's not enough to just hear it explained or read about it in a book. You actually have to do the calculations yourself.
Exactly. The sources provide numerous practice questions covering all these areas: commission calculations, prorations using both 360 and 365 days, loan amortization, LTV, PMI, points, cap rates, simulating the types of problems you might encounter on the licensing exam.
And working through those problems is how you build the muscle memory, right? The familiarity needed to perform these calculations quickly and accurately, especially when you're under pressure, like during the exam or even explaining something to a client on the fly.
Precisely. Build that muscle memory.
They give some practical tips for practicing too, like not clearing your calculator between steps in multi-computation problems. Why is that important?
To avoid intermediate rounding errors, if you round off too much after each step, your final answer might be slightly different from the correct one, especially in longer calculations like amortization or tiered commissions. Keeping the full number in the calculator helps maintain precision.
Okay, good practical tip.
And they also advise, kind of reassuringly, not to sweat the small stuff, meaning if your calculated answer on a practice exam is off by just a few cents compared to the multiple choice options.
Pick the closest one.
Pick the closest one, yeah. Minor variations like that are often just due to slight differences in how rounding was handled. Maybe they use the 360-day year when you use 365, or vice versa if not specified, or rounded decimals differently. Don't let tiny differences throw you off if your process was sound.
Okay, good advice. Practice helps you become more comfortable, faster, and more accurate. And that accuracy translates directly into confidence when you're dealing with real-world scenarios, doesn't it?
Absolutely.
Being able to quickly calculate a seller's estimated net proceeds sheet or double-check a buyer's cash-to-close figure on the world time. Closing disclosure isn't just about getting the numbers right. It's about providing reliable, accurate information that your clients are depending on you for.
Ultimately, mastering this math is about professional competence. It ties back to that ethical compass. Your clients are making incredibly significant financial decisions, maybe the biggest of their lives.
For sure.
And they're relying on you to understand and accurately convey the numbers involved in the transaction. Having a firm grasp of these calculations is truly a cornerstone of providing ethical, competent, and trustworthy service. Intentionally misrepresenting numbers would clearly be unethical, but even unintentional errors due to lack of understanding can harm your client and your reputation.
Well said. Okay, let's try to recap this deep dive into the essential real estate math for California agents.
All right. We kick things off with the absolute foundation, the power of percentages, and that versatile part-whole rate concept, visualized by the T-bar method, which applies to so many calculations involving rates and amounts.
We then applied that foundation to calculating commissions, figuring out the commission amount when you know the sale price and rate, calculating the rate when you know the amount and price, and even stepping through a more complex tiered commission structure to find the total sales volume needed to reach a certain earning.
Then we dove into the world of prorations at closing. We talked about why expenses and income need to be divided based on ownership days because of things being paid in arrears or in advance. We looked at the two calculation methods, the 360-day banker's year and the 365-day calendar year.
And remembered our CA corner note that California typically uses the 365-day method.
Right. We walked through examples for prorating taxes, debit seller credit buyer, rent paid in advance, debit seller credit buyer, and the buyer's prepaid new loan interest, debit buyer, seeing how these adjustments appear as debits and credits on the settlement statement.
We also explored financing fundamentals. We differentiated simple interest from the more relevant compound interest concept, understood the quick rule of 72 for doubling time, and, importantly, learned how to calculate the interest and principal portions of a fixed monthly mortgage payment to track the loan balance reduction through amortization.
We also covered key related loan concepts like loan-to-value LTV ratio and its connection to down payments, the requirement for private mortgage insurance, PMI, when LTV is high, and how to calculate the break-even time frame to evaluate the cost-effectiveness of paying discount points for a lower interest rate.
And finally, we touched on some math concepts relevant when working with investors. We defined capitalization rate, cap rate, and its calculation using net operating income, NOI. We acknowledged its limitations and mentioned discounted cash flow, DCF, as a more complex forward-looking valuation method.
And we briefly defined other useful investor metrics like cash-on-cash return, measuring return on actual cash invested, the debt service coverage ratio, DSCR, that lenders use, and that 70% rule, ARV, my .70, is a quick filter for fix and flip deals.
All of these calculations, while distinct, really serve the same core purpose, bringing clarity, accuracy, and precision to the financial side of real estate transactions and analysis. This math isn't just an exam hurdle. It's a practical, everyday tool that empowers you as an agent and, crucially, instills confidence and trust in your clients.
You've genuinely started building your financial superpower today by working through this. The absolute best next step you can take, truly, is to grab those source materials we base this on, look at the examples and the practice problems provided, and start working through them yourself. Get your calculator out.
Don't just read the solutions passively. Set up the problems yourself, apply the formulas or draw out the T-bar method, and calculate the answers step by step. If you get stuck, review the steps we discussed here or in the source material. The more you actively practice, the more intuitive and second nature these calculations will become.
It's exactly like building any skill, learning an instrument, playing a sport. It takes repetition, consistent repetition.
Yeah.
And remember those practical tips. Keep intermediate results in your calculator for multi-step problems to maintain accuracy, and don't sweat minor rounding differences on practice tests if your method was correct. Focus on understanding the underlying process and logic. Confidence in real estate math is absolutely achievable with consistent effort and practice.
Great encouragement. Next time, we'll shift gears and dive into another critical aspect of your California real estate journey, pulling key insights from more source material to help you succeed.
Until then, really, get comfortable with your calculator. Find those practice problems, taxes, commissions, prorations, loan payments, and start applying what you've learned today. Building this solid math foundation now will make you a more effective, confident, and trusted agent down the road. You've definitely got this.
Make sure to subscribe so you don't miss our next deep dive.